Hello and welcome to another TLC Tutoring Company accounting lesson. We have another differential analysis problem for you. Again, we are not going to be using tables. We are just going to be analyzing these concepts in a general accounting sense. So here we are going to be analyzing a make or buy situation. We have Stone Company that produces a product that requires the use of a special type of bolt. The company can either manufacture the bolt, which is what they currently do, and currently they manufacture these in batches of 1,000. So you'll notice that when we get to the buy portion of this problem, they're also going to be buying in batches of 1,000. So we're always going to be doing this analysis as it relates per batch, right? So to produce one batch, the company incurs $100 in manufacturing costs. Now, if you think about your manufacturing costs and you think about the different cost behaviors that you hopefully learned previously, you'll remember two main cost behaviors, variable and fixed. They're telling us that this $100 includes $30 of fixed manufacturing costs. So keep that in mind. It also says that the company's manager has asked a third-party company how much it would cost to purchase the bolts from them, and they responded that they could charge the company $80 for every 1,000 bolt order. So considering that the fixed costs associated with manufacturing the bolt are unavoidable, this is going to be very important. Determine whether Stone Company should continue to produce the bolt themselves or purchase the bolt from an outside source. All right. So we have two scenarios that we're analyzing here. We have to analyze the make and the buy, and then we're going to decide which one is more affordable for Stone Company. So when we're talking about making these batches of bolts, notice that the $100 in manufacturing costs, $30 of that is fixed costs. So the other $70 of that would be variable costs, and that is what makes up the $100 price or manufacturing cost. Now, don't stop here because we are actually going to be analyzing this a bit more. Now, keep in mind here, think about the nature of fixed and variable. Variable costs are those costs that you incur as you're producing more items, more units of good. So with every batch that we produce, we are going to be incurring $70 of variable costs. This could be direct materials, direct labor, variable factory overhead, but essentially that $70 is something that we just can't avoid. It's kind of like if you think about, oh, you're baking a cake, what kind of costs are you going to incur as you bake the cake? Well, you're going to have to pay for the direct materials, which would be things like flour, sugar, milk, eggs, direct labor, the cost of putting it together, and then maybe some other very minor factory overhead or variable factory overhead as well. Now, fixed costs, on the other hand, these can usually be considered avoidable or unavoidable. So let's think about the nature of fixed costs. Let's say one of our most popular fixed cost examples, let's say that it is the rent on this manufacturing plant. So the rent, our landlord doesn't care if we decide to stop creating bolts. We're still manufacturing our product in that manufacturing plant. So the fact that that one piece that goes into our product, the bolts, are no longer being manufactured there, they don't care. So we're still going to have to pay rent. So the whole purpose of analyzing this here is this part here where it says, considering that the fixed costs associated with manufacturing the bolt are unavoidable, this means that if we stop manufacturing this bolt, we are still going to have to pay those $30 in fixed costs. It's simply going to be allocated somewhere else within the manufacturing plant, perhaps to the production of a different piece or of a different product. So when we're talking about the make scenario of this differential analysis, we actually would not consider the fixed part at all, because we are going to incur those fixed costs whether we manufacture that bolt or not, because those fixed costs are unavoidable. So really, the cost of us deciding to manufacture the bolt is $70 per batch. That's it. Now, when we're taking a look at the buy scenario, on the other hand, what tells us that we could buy this in batches of 1,000. Every batch would cost us $80. Here, I'll actually put it on this last line here so you can compare them easily. $80 to buy. So we can either make it for $70 or we can buy it for $80. No other costs are associated with this buy. Sometimes you might see that there is some type of delivery cost or shipping cost involved. In our scenario, we don't have one. So really, these are the two alternatives that we are analyzing. Are we going to spend $70 to manufacture the bolt, or are we going to spend $80 to buy the bolt? And that $70 is cheaper, so we are going to want to make the bolt rather than buy it. So take some time to think about those differences between variable and fixed costs. Make sure you understand what the problem is saying when it says that a fixed cost is avoidable or unavoidable. This is going to be very important for understanding these types of problems later on. Until next time, happy studying.